So, as promised, here's the second part of the product life cycle presentation, and we're going to start off with Boston Matrix. So Boston Matrix is basically another tool that the business can use when it's deciding what products to launch. It can help them decide help them to categorize the products that they already have in their portfolio. But in order to do that, we've got to look at what our portfolio is. If you think of portfolio, that's something we carry around. In art, for instance, you would carry a portfolio around. It has all of your work inside it. So think of it like that. The business's portfolio is all of the products that it has to offer. So we have to be able to sell the right product in the right segment of the market, and that's one of the decisions we have to take when looking at our portfolio. It is sometimes helpful to undertake market research to ascertain where other products are on the market and where each of them is positioned. So if you look at this example that we've got here, so we've got price along this axis, along the x-axis, and we've got, although I've cut it off there, we would have quality along the y-axis. So for instance here we have this divine chocolate. We have that as high price, high quality, and down here we have Kit Kat, which is relatively poor quality but low price. So we know that if we're going to launch a new bar of chocolate, it would be pointless putting it just there. It would be pointless putting it just there because there's products already in that part of the market. So we need to make sure that if we are trying to extend our portfolio, that perhaps we target somewhere here or somewhere here. So once we've collected this type of information, we can plot it. So this is for the entire market of chocolate, for instance, but it could be that just Cadbury do it and they show where their products are. So Cadbury might have different products in different places, and therefore they have a gap here, for instance, and they want to launch a new product. So it can be done for the whole market, or the business can do it just for its own product portfolio. So once we've considered our product portfolio, we have to decide whether that portfolio has enough in it or whether we need more to go into it. So the information from this positioning chart, or you might hear it called a marketing map, can be used to help the business decide if it wants to produce a product that will fill a gap in the market. However, the business does need to be careful because there may be a very good reason that there's a gap in the market. For instance, as I say, if we look high price, low quality, would be pretty daft to try and launch something there, because why would someone pay a high price for a low quality chocolate when they could pay a high price and get a high quality chocolate? So there may well be a gap in the market for a reason. So a business might decide that it too should launch a product where all the others are concentrated in, so here for instance, or it might mean that they try to avoid where everything else is. So that might be part of us in our product portfolio decision. Do we try to match our competitors, or do we try to go somewhere where they're not? Cars are often a good example of this. So each model ensures that the name of the manufacturer is represented in as many segments as possible. If you look at Ford cars, for instance, they've got the Ford car, the Ford Focus, the Ford Galaxy, the Transit van. They've got loads of different cars and loads of different vehicles in different segments. So that's what we mean by a portfolio. Have we got different products that meet different people's needs? So as we say then, a business with a range of products has what we call a portfolio of products. It has a product portfolio. Owning a product portfolio poses a problem for a business. It must decide how to allocate investment, so in product development or promotion, across that portfolio. So this is where the Boston Matrix comes in hand. So a portfolio of products can be analysed using this thing called the Boston Group Consulting Matrix. We'll probably just call it the Boston Matrix. So as we've said, this is a way of categorising products into one of 4 different areas, and it's based on relative market share, which is what we plot along the bottom here, against relative market growth. So how big is the market? Does the product being sold have a low or a high market share, and are the numbers of potential customers in the market growing or not? So how it's constructed first of all, we have to make a number of key assumptions. Now, we need to be careful about these assumptions when we're analysing, when we're in analysis questions. If you're talking about the Boston Matrix, you have to take these into account. So market share can be gained by investment in marketing. That's the first assumption. It's a big assumption to make. So just because we're investing, we're assuming that market share will go up. Well, that's not necessarily always the case. If our investment's wrong or our marketing is wrong, then our market share may well not go up. Market share gains will always generate cash surpluses. Well, not if we've had to spend more than we receive in return in order to get those market share gains. Cash surpluses will be generated when the product is in the maturity stage. Well, that's a little bit less contentious, but still, just because we're in the maturity stage, we might be having to spend a lot of money to stay there. And the best opportunity to build a dominant market position is in the growth phase. I think that's fair enough. There's not much we can argue about there. So how does the Boston Matrix work? Well, the four categories can be described as follows. So a star is the category where the product has high market share and is in a market which has the potential to grow. It's sometimes referred to as a rising star. Although this may appear to be the best category to be in, it is slightly misleading. In order to gain and maintain a high market share, the business may have had to advertise heavily in order to establish itself fully, and it might have to have a very high advertising spend. Such products do have the potential to be future cash cows though. So cash cows, following on from the previous one, are low growth products, but they are in a category that ensures high revenues. These are established products that have a high market share, but although the market growth is low, the product generates a large amount of cash. The cash cow is normally a mature product, so it's been around for a long time, that does not need heavy marketing expenditure because people already know about it, and therefore sales revenues are profitable. Being sold in large quantities allows for a low unit cost, so economies of scale means a low unit cost and therefore high profits. The large profits gained from cash cow products can be used to support problem child products, which do need the investment. So we'll look at that now. Also known as question marks, but problem child products have a low market share within a market that is rapidly growing. The aim for the problem child, or the aim for a question mark, is to hopefully one day become a star or a cash cow. That's the way to remember it. Our parents, even if we were problem children, wanted us to become stars. In order for this to be achieved, the business will need to invest heavily to help increase the market share of a product. So that's where the money from a cash cow, for instance, could be useful. A problem child product is normally a new product that is yet to establish itself in the market, and consequently it's not profitable yet. So investment in marketing is needed in order to raise the profile of the product within the market that we know is already expanding. The dog products, unsurprisingly, are those that have low market shares in relatively unattractive, low growth markets. Consequently, they don't really have any future in the company. Unless the dog is vital to the range of products offered by the business, it ought to be dropped as quickly as possible. So sometimes we do keep them so we can say that we're in lots of different markets to keep our stakeholders happy, but they're not really making us any money. Usually they break even, but they're not really going to bring in any money. Ideally, a business would prefer products in all categories apart from dogs to give it a balanced portfolio. So we wouldn't always just want cash cows, because one day if those cash cows were to decline, we wouldn't have any rising stars to replace. So the advantages of using Boston Matrix. Well, by looking at its range of products within the Boston Matrix, a business can see if it has a balanced portfolio and whether it has sufficient cash cows to feed the problem child. A business doesn't need dogs, but does need cash cows in order to convert problem child products into stars or cash cows. Too many stars, though, may actually be a drain on financial resources, as they do require large funds to maintain their position in a growth market. Disadvantages? Well, we looked at those when we looked at the assumptions. I think a lot of the assumptions that we made are quite big assumptions, so those are disadvantages. But basically, it's some more of the disadvantages that we need to look at is in more of these assumptions that we're making. So just because a market's growing doesn't mean that's going to be attractive. It could be that there's lots of competitors in there. So just because a market's growing doesn't mean our product's automatically going to be a star, for instance. Just because if we focus on market share and market growth, it does ignore things such as sustainability. So it might be that our market share is going to expand rapidly. Our market growth, the market as a whole is going to grow rapidly, but that might go overnight. So, for instance, markets that associated with Christmas, they might grow rapidly, but they're gone on the 26th of December. It's only a snapshot of the current position, so it only looks at what's happening now. So because of that, it has little or no predictive value. We don't know what's going to happen in the morning, in the afternoon, the next day. It doesn't take into account environmental factors, so it doesn't take into account other companies, for instance. It doesn't take into account the government. It doesn't take into account society, fashions, technology. Just a little recap of the different facets of the different categories. So a star product has a high market growth, high market share, is cash neutral, so roughly the same amount of money that's being spent on it is coming in. We should hold on to these. A problem child is in a market with high growth. It has a low market share this time and cash absorbing. So if we've got a problem child, it's going to take in more of our cash than it's going to create. We should try and build on these. A cash cow, we try to milk them. It's going to be in a market with low market growth, so it's going to be in a mature market, but we're probably going to have a high market share in that mature market. This one generates cash. So this one is where we can use the cash to support a problem child, or we can use the cash to develop a star into a cash cow. Dogs are low market growth products with low market share. They are cash neutral, so we don't spend a great deal on them, but nor do we make a great deal from them. We should divest these, hopefully try to get rid of them. So just to remind you then, we use the cash from a cash cow to make up for the fact a problem child is cash absorbing. We use the cash from a cash cow to help a star. Hopefully that star will then one day become a cash cow, and hopefully one day, if we've spent on a problem child, that may well become a star. So that's the bonus of having a product portfolio, is that it means that over time we're not focusing on just this one cash cow, we're not focusing on one product, but we're helping develop problem child products into stars, and we're helping develop stars into cash cows. So by having a varied product portfolio, we're hopefully planning for the future and reducing the amount of risk that we have. In order to make products of a business stand out, they do need some form of product differentiation. In a mass market, so when we're looking at our product portfolio that has lots of different competitors, any form of differentiation will help to make the product distinctive when compared to the rest of the market. Careful branding or having a unique selling point can achieve this. Even the best established brands occasionally need to relaunch or reposition their brands to help maintain market share. Heinz Beans is a great example of this. It wasn't not too many years ago, 5-6 years ago, Heinz moved away from calling their baked beans Heinz Baked Beans to simply Heinz Beans. That's so they could link it to their really old slogan of beans means Heinz. This repositioning, re-established the brand name and associated with quality. So if you're thinking about beans, it must be Heinz Beans. So regardless of whichever brand of beans you're going for, in your head, hopefully what Heinz are thinking is you'll think of Heinz Beans. So we can differentiate our product through price. Remember, it's not always by lower price. We can differentiate it by being slightly higher, because hopefully that will lead to higher quality. It's not just perceived quality though, it can be actual quality, such as our product might be more durable, or it might be in a niche product. It might be in a niche market, only cater to a certain number of people, which might mean there aren't as many competitors, or it might do something completely different. This was the case when James Dyson launched his vacuum cleaner. Nothing else was like it on the market. So whenever a product is positioned, so remember that marketing map I showed you before, it aims to increase revenues, either directly as a result of higher sales of a specific product in a specific position in that market, or indirectly by being in the market and therefore enhancing the brand name of the entire product portfolio. But in some way, each product in that portfolio must be doing something. If not, then why is it there?